Over the past 3 fiscal years, Nigeria's MDAs have been running on budget promises rather than budget cash, with approved capital spending outpacing actual releases by over 15 trillion naira. As debt servicing tightens its grip on government revenues, funds meant for infrastructure and development projects are quietly sacrificed at the altar of repayments. The pattern exposes more than a cash crunch. It highlights shaky budget realism, blurred fiscal priorities, and weak execution. The result is a growing gap between policy intent and public service delivery, with underfunded MDAs becoming a silent drag on productivity and long-term economic growth. Joining us to break this down is Kalu Aja, certified financial educator. Good morning and compliments of the season.
Nice to be here.
Yes, always a pleasure. Before we dive into the subject at hand, MDAs, I do have to ask you, obviously many of us woke up to the news of an escalation of U.S. military action on Nigerian soil. What does this mean for our economy? What does it signal to investors?
Yeah, when I looked at the news, right, I was just watching to see if the Nigerians were aware of it. From the press side, from the Nigerians, they are saying they were aware and they actually coordinated with the United States government. So that means that there's coordination going on. There's no big surprise. So if I was an investor, I would be worried if the U.S. struck Nigeria and weren't aware of it. That would mean there's no coordination and there might be sanctions going to happen maybe on Monday when the markets open. But it looks like Nigerians and the Americans are coordinating together to fight terror. So no huge surprises there. So we shouldn't see like a sell down of Nigerian bonds or Euro bonds in the foreign market. So that sort of gives me a bit of should we say, stability, more or less. So just the economic side, that's what I'm looking at. And I think that's what other investors are looking at as well.
We'll focus on the economic side. But coming to the conversation at hand, MDA is underfunded by 15 trillion. And with approved capital budgets falling short of the actual releases by trillions of naira over several years, what does this level of underfunding really mean for economic activity and the daily lives of we ordinary Nigerians?
Yeah, it's a huge, financial irresponsibility. That's the way you have to look at it. Fiscal irresponsibility. So there's on one side, there's the fact that we are announcing huge budgets for capital expenditures. That's to build roads, to build airports, to build railways, which are essential to take Nigeria to the $1 trillion economy and to sustain our population, right, to create that productivity. We're announcing these huge budgets, but we're not funding them. But the other larger point is that we're actually borrowing enough money to build the infrastructure, but then we're diverting the borrowings to do other stuff. I'll give you an example. 2024, the capital budget was 13 trillion, 13 trillion. But what was cash released for the capital expenditure in Nigeria was just 6 trillion. But then we borrowed 12 trillion in 2024. So clearly we could borrow 12 trillion and we could have used, even if it's 10 or 11 of that to build infrastructure. But no, we only take 6 trillion for infrastructure. It's worse in 2025. In 2025, we are seeing less than 400 billion. That's 400 billion being released as cash to MDAs for capital projects from about a 23 trillion naira budget. It boggles your mind. Just 400 billion for the entire 2025 fiscal year. If you don't build infrastructure, you can't be productive. You cannot grow the economy. So that's right. There's a summary of what we're talking about.
Are you suggesting that there's a leak somewhere?
The money is being diverted to debt servicing. It's not being stolen like a leak. We know where the money is going to, and that's the responsibility part of it. Because we are raising revenues. In 2022, Buhari handed over a 7 trillion income to President Tinubu, 7 trillion. President Tinubu has taken 7 trillion to 20 trillion revenues. So as at 2024, President Tinubu is creating about 20 trillion revenues. But he's spending too much. He has spent 34 trillion in the same 2022, and then he has borrowed about 12. So the problem isn't that the money is stolen, but he's borrowed too much. The revenues have not come in. So all that money is going to pay back debt, not to pay back, to service the debt. 2025, we are spending 74% of our revenues to service the debt. 74. Then, of course, you got to pay salary before you then do a capital project. So that's the irresponsibility part of it. Too many projects, not enough money to pay for it, and we just keep on adding more and more projects to the board.
And you've touched on what has happened. I think now we need to take a look at 2026, the 58.47 trillion naira budget, debt servicing 15.52 trillion. So, I mean, let's look at debt servicing. It's steadily consuming a larger share of government revenue each year. How serious is this becoming for fiscal sustainability and the government's ability to fund development? And what's the wiggle way out of this?
Yeah, so the debt servicing hole is created when you overestimate how much revenues they're going to make. And Nigerian revenues are really just crude oil exports, the sales price, and then the sales volume. We've over promised on that. 2025, we are promising about 2 million barrels to be exported. What we're doing is about 1.4, 1.5. We use that $75 a barrel to export crude oil in 2025. Oil is nearly about 60 today. So that creates a whole fiscal side. But then we borrow as if we've met our income. And then that then creates that hole that we can't cover because we can't print dollars. We've got to go earn dollars. And that's the problem. So once you know that problem, how do you fix it? You've got to cut back on your spending, which is specific. You cut back on all these projects. I haven't heard any project that I've announced that is bad. I want to have a road from Sokoto to Badagry. I want to have a road from Lagos to Calabar. But you've got to pay for it. And you've got to pay for those roads in dollars because you're going to import the equipment, the steel, the cement to build all those bridges that you want to build on those roads. So if you can't afford it, you can't put it on your budget. You've got to cut your coat according to the cloth, not your size. And that's the big problem. We're not dropping projects. We're carrying over 2024, 2025, in 2026. What we should be doing is cutting down projects as per austerity and saying, well, we can't afford this. We're going to slim down the budget, do a zero-based budget, and then go to what we can afford. If oil price goes to 50, the entire budget is going to be blown up. But remember, the debt is not blown up. It's going to be there, and you have to keep on paying it year to year.
And I mean, you've basically highlighted the root of this whole issue, which is the overestimation of revenues. At the budget presentation, the urgency of realism was emphasized. There's some who would say that the benchmarks that were rather conservative. What do you make of some of these benchmarks in terms of, production volumes when it comes to oil? Oil price estimate $64.85 a barrel, exchange rate. Would you say we're now in a realistic cycle when it comes to estimates, or we're still overestimating?
Yeah, well, the two key assumptions that really counts is the crude oil price, which we don't control. Then we control the crude oil export volume, which we can't get there. The crude oil price, we're putting about 64 a barrel. I think that's very, very ambitious. If Ukraine and Russia achieve a peace in 2026, oil prices are going to crash. They've already crashed to about near 60. So if there's peace in Ukraine, you're looking at $55 a barrel oil, literally. So we have to really be very, very drastic and go as low as 45. That puts us a very, very conservative number. So if oil prices go back to 100, that's fine. You built up your ECA, but don't gamble on 65 barrel oil and say you're being conservative. Events are changing as we speak. On the oil output, we've gone from doing 2 million barrels a day in 2005. Now we're struggling about 1.4, 1.5 and all that. OPEC is 1.5. We're doing about 1.8 now. NNPC itself is saying its target is 2 million barrels a day in 2 years from now. So we've been a bit under ambitious in saying 1.8. These two things matter because if you write a budget on $64 per barrel and 1.8 million barrels a day and you don't make it, you've already borrowed. You've already spent based on these numbers. So I would ask us to be a bit more conservative. Give ourselves a lot of wiggle room, a margin of safety. In case the revenue do not come, we can still get by. We're making nothing from non-oil, nothing. We're making Naira revenues from non-oil. But the economy runs with dollars. We make dollars, we convert our dollars to Naira, and then we pay salaries. If we can't sell crude oil, we can't pay salaries. Non-oil is less than 20% for the total revenues. We make more in Naira terms, but we can't print dollars. That's the problem. We can print Naira, ways and means, but we can't print dollars. So it's a big problem there, if you ask me.
And it sounds to me like you're saying that with production at 1.8, we are being under ambitious.
We're being over a bit. I would take it lower. So if there's any shock, you have enough shock absorbers to cover. If we're doing 1.4, 1.5 today, leave it there. Leave the target at 1.5. Leave the oil price at 45 to 50. If you do more, that's an excess that goes to your savings, your excess crude account savings. But if you used 1.8 and 64 as your target and you do less, you've created that fiscal hole that you then have to go borrow money from and then create this overlapping and missing budgets that you have to carry over to the next year. The way you stop these holes in budget is to stop the spending. And the way you stop the spending is by reducing the amount of projects that you add onto the budget that then create the need for the spending.
So it's better to err on the side of caution. When MDAs are forced to operate with less than they were budgeted for, where do Nigerians feel the impact the most, and what critical services or projects are typically the first to suffer?
Well, you see it every day. Look at, when you put stress on any asset in Nigeria, it crumbles. The roads from Abuja to Lokoja crumbled during the holidays as stress was put on them. The roads from Benin to Asaba crumbled when you put stress on them. The airports also have crumbled. We've raised prices to 1 million. Still, there are passengers, folks can't travel. We have just the ports in Lagos control about 88% of Nigeria's exports and larger percent of Nigeria's imports. So again, stress, where we focus all our industries in one location and we'll stress them. And that's the problem. You're not expanding the economy. There is no money to build out the economy. So once there's any stress, any activity, we feel it. That's why you see prices going up, because you have the food in the north, but you can't transport it cheaper and faster to the southern cities to eat and then reduce the price of food inflation. So all these things are connected and are circular. If we make harvests and the harvests are plentiful, but we cannot distribute with them with proper logistics, store them, move them to the cities, you're going to have very, very high inflation. So all this matter. No roads lead to higher inflation, not just food prices. If you don't have good roads and good rails, your rice bag still stay high, and you're going to spend more money on inflation to afford to eat. So it's a big problem there.
Indeed. And looking beyond the pressure from debt obligations, what institutional or administrative factors usually prevent funds from reaching MDAs on time?
It's really just down to, if you have the money, you share it. That's really what it is. You see, now they've moved the budget till March 2025. It's not going to be completely March 2026. It's really just money. When they have the money, they can create a budget on time, i.e. have a 2026 budget passed in 2025. So you administratively, you already have the approval to spend once January starts. But you're going to find out that by January, March, April, that's when we'll have to talk about releasing cash flows for 2026. So you're already behind the year. Remember, we're doing 2024 in 2026. So we're behind for 24 months already. So the whole process, maybe we should move to a 2-year budget or a zero-based budget, or have a project budget. Then we take these monies out and give it to a fund, and that fund will then sort of take over the project. But the idea of doing these annual appropriations for projects that we don't have the funds for, it's not going to work for Nigeria. It's that we have the money in 1 year and then appropriate what we have raised. So we stagger it a bit, or it's just not going to work. Well, how can you budget on what you don't know about? We don't know the price of crude oil. We're going to run a budget saying we're going to spend, if we sell oil at $64 a barrel. Oil can get to 100 tomorrow, and I can get to 20 tomorrow. So that's really not a good way to plan, really.
Interesting recommendations, the 2-year budget or a project budget. Nevertheless, what we have and what was stated, or how this 2026 budget was described as a reset budget, or they'll pay all contractors, they're going to avoid abandoned projects. By March 31st, projects will be fully funded and closed and will be operating on one budget. I can see the look on your face. Are we on our way there? Is there anything you can see right now that gives you the confidence that yes, we'll be able to see this through, and by April 1st we'll be running on one budget, no carryovers?
Yeah, I mean, we just explained that the whole idea why we have this carryover budget is because we are overspending. When you pay contractors that spending, we just announced what to ASU, we're going to increase ASU salaries by 40%. We're going to pay 2024, 2025 contractors, we're going to build projects. All that is spending. Where is the income? Where's the income? You don't hear the income side talking, you hear the expenditure side speaking. So as long as we don't have the income, we're going to keep on carrying over obligations. And we cannot pay obligations 6 months into 2026. Not possible. So again, we're digging ourselves by making promises we cannot keep, unless we're going to go back to ways and means and then print Naira and pay these folks off. Otherwise, how is I going to get the money? How is I going to get the money? Remember, 74% of Nigeria's revenues at as half year 2026 is going to service the debt. 74. We won't talk about salaries, just debt servicing. So you have how much left? I want to pay all these contractors, you want to pay us, you want to pay the military, we're going to have to increase their budget. Where's the money going to come from? Maybe the US will give us a loan, but for now, I don't see.
So no confidence in that April 1st single budget deadline. All right, let's stay with the MDAs and them being underfunded. Even in cases where the funds are eventually released, why do many capital projects still stall or even fail to progress as planned?
Yeah, it's really down to project management, right? You see the minister going to look at projects. That's fine. But really, should he? How many projects can he track? So there's a sense of that if the minister is not there physically or to look at stuff, maybe things might not go as planned and all that. We should have inspectors that will say, hey, this road is being built according to standards. I mean, we have drones. The minister can sit in his office and look at the whole project by drone. But there's just this sense that contractors take too long. There's so many excuses that the year goes on. And we have a very funny year because once the rain starts, we can't build roads anymore. We have to wait till rains to go over, then we continue. We don't build roads at night like we see offshore where they build loft. They build at night when there's less volume, which I tend to build them during the day where folks are going to work. So I think it really just comes down to funding. If you give large construction companies the funds and you say build a road, they will give you a time and you should get that road within that time. But once you give the local folks, because they operate more like, they don't have the equipment to deploy mass and scale like the foreign-based construction companies do. They are more susceptible to having their funds on hand to do projects. They really can't go out and borrow. They don't have a lot of cash on hand. So again, if you're going to do a large project, be very, very careful who you give it to. If you give it to a local player, that is cheaper on the surface, but that guy has no observers to then do that project and then give you a payment order to receive payments on credit. So just be careful who you choose for this national large-scale project. That's just what I'll say.
And for a private investor who's watching all that's happening, watching the government struggle to fund its own capital projects, what signal does this persistent underfunding send about the risk of partnering on infrastructure?
Well, if you're an investor, they're smiling because that means that the government's going to come to them to borrow money in 2026. That means federal government bond rates are going to still be elevated, which is just good money for investors that have got disposable cash to put aside. The government needs to do more in terms of dollar bonds. They got to get dollars into Nigeria, not Naira. I mean, we need dollars to come into the country. We can deploy those into long-term capital investments. The federal government does not have the money, even if there's no budget hole, to build infrastructure in Nigeria. It's just a misnomer. We have just housing. We're talking nearly 50 trillion, just housing, not talking about roads and rails. So we've got to involve the private sector in building out infrastructure and then do this through tax credits. If you build a road here, take the money from your tax credits. We have to extend that to the states to local government. We've got to do more partnership with the state to build infrastructure. But if an investor, I think you're looking at the government coming back to you to borrow more money from you in 2026, which makes you a bit happy. Let's see how that plays out. We really just got to make sure that we bring the macroeconomic side in line. The inflation has to keep on staying low. GDP has to keep on going high so that the foreign investors can still bring money in. We're operating with foreign portfolio investors, not foreign direct investors. They are more short-term and they want to see things, they want to see high rates. So that's also a problem, but that's what I'll put leaders at for now.
And looking at all that has been said, obviously the root of this problem, what you have stated, is the overestimation of revenues. If borrowing continues to crowd out capital spending, what realistic alternatives does the government have to fund infrastructure without worsening its debt burden?
Yeah, it's got to do off-balance sheet financing. That's just the solution. Do off-balance sheet. It means you take a project, you ring-fence it as a revenue bond. So if you go to the guys, maybe you say you want to build a road, Lagos to Port Harcourt, right? Cut that road into sections. And you say, for this section, we're going to toll it. If you invest in this section, you get paid the tolls. From Onitsha all the way to Lagos, everyone's going to invest on that road because that's a gold mine right there. If you toll that road, Onitsha also down to Calabar and all that to the port, also a gold mine. You're going to get folks that would invest in those roads because it's like a bond. And Dangote is paying $1 bond. You can also say you want to pay $1 bond. And if you attach that road to the port and say, we're going to get dollars from the port, we're going to give you a bit of your revenues in dollars, then you attract the diaspora Nigerians that would like to invest in Nigeria, put that money in Naira, and in 30 December, they get some funds to then spend in Nigeria. You've got to get innovative. The government can't do this. So, but if you break the road down, you can have sections of that road built now and not wait for Lagos road to go all the way from Lagos to Calabar. So involve the private sector in projects. Do a ring-fenced revenue bond. So it's not going to the budget of the federal government, but it's going only to that project. I invest in the project, I get dividends from the project, I go to bed. That's really the way it's done, offshore securitizing of future receipts into a bond, and then I invest in that bond. Otherwise, we're not going to go anywhere waiting for the government to build roads and rails. It's not going to happen.
Well, I hope they're listening. Kalu Aja, certified financial educator. Thank you so much for your time and perspective on the show today.
Thank you so much. Have a good day.